If you own CoreWeave, Tuesday's print decides what you're actually holding. Tuesday afternoon, after the closing bell, CoreWeave reports its second quarter. The consensus going in is $2.5 billion in revenue and a loss of $1.17 a share, and the stock has already run 26% in a week straight into it, closing Friday at $90.67. So before anybody tells you what that number means, here is what every model says this company is worth going in. Here's the ride you've been on. $40 at the IPO March 2025, roughly $187 by June, widely reported at the time, up 365% in under 3 months. Then the drop, $60.55 at the low, $90 today. And in January, Nvidia bought $2 billion of this stock at $87.20. So you're one of two people. Either you bought the dream above 150 and you're down 40%, or you paid roughly what Nvidia paid, and Tuesday decides whether that was the floor or the trap. So what is Wall Street's favorite AI stock actually worth? Not what it trades at going in, what it's worth. I rebuilt every model the banks and the great investors actually use. Discounted cash flow, peer multiples, reverse DCF, 10,000 simulated futures on public numbers. By the end, you get one price and one word: undervalued, fairly priced, or overvalued. The models say it, I don't. And there's one sentence in the annual report that none of the models agree about. 12 words about how long a graphics card lasts. Change the number in it and this company's profit margin flips sign. So we're running every model twice before the number lands. 2 letters. I'm handing you to the
88% of CoreWeave's revenue last quarter came from contracts signed before the quarter started. That's the business. It doesn't build AI models. It builds the rooms they're trained in and rents them by the hour on take-or-pay contracts that run years. And the unit that matters isn't servers, it's electricity. Roughly a gigawatt of power live, more than 3.5 gigawatts contracted. A gigawatt is a large nuclear reactor. That's the scale of the thing you own a share of. The man who priced those contracts is Michael Intrader, and he didn't come from tech. He traded natural gas, ran a hedge fund on it. Then in September 2017 in New Jersey, he and 2 other commodities traders started a company called Atlantic Crypto and pointed a shelf of gaming cards at Ethereum. The crypto crash killed that in 2018. They kept the cards, sold the compute to anyone who needed it, which turned out to be everyone. Now the number the bulls put on every slide: $99.4 billion of contracted revenue backlog at the end of March, up 284% in a year, against $6.2 billion of actual revenue over the last 12 months. 16 times coverage. Meta committed $21 billion of it in March. OpenAI signed roughly $12 billion over 5 years. Anthropic came in April, and the growth underneath it is not a rounding error. $1.9 billion of revenue in 2024, $5.13 billion in 2025, $12 to $13 billion guided for this year, with the company telling investors it exits the year running at 18 to 19. Almost nothing at this size grows like that. So the comps model goes first. On the company's own $12 to $13 billion guide for this year, CoreWeave trades at roughly 3 times forward sales. Nebius, its closest listed rival, trades at 9. Nebius carries nearly CoreWeave's entire market value on 1/7 of the revenue. On that math alone, the latter puts the first rung at $137.91, one model in. It's the sentence word for word from the annual report. Effective January 1, 2023, the company changed its estimate of the useful life for its computing equipment utilized in data centers from 5 to 6 years. 5 to 6, 1 year. That 1 year is the whole argument. When you buy a machine, you spread its cost across the years you expect to use it. 6 years means you write off a sixth a year. 3 years means a third. Same card, same cash, wildly different profit. And a GPU isn't a delivery van. Skeptics have argued since the IPO that a frontier chip is commercially finished in 2 or 3 years, not because it stops working, but because the next one makes it uncompetitive on power and performance. Watch what happens to last quarter. Adjusted EBITDA margin 56%, sounds like a software company. Adjusted operating margin 1%, it was 17 a year ago. And underneath both, a GAAP loss of $740 million in 90 days. The distance between 56 and 1 is depreciation and interest, and depreciation is set by that sentence. Hold the 6-year life, and this is a thin, growing, capital-heavy business. Shorten it to 3, and the margin goes negative before you've paid a cent of interest. So every model from here runs twice. Discounted cash flow, 6-year life, $120.47. Same model, 3-year life, minus $120 a share, which is this model's way of saying the equity is worth nothing at all. Reverse DCF, which stops asking what it's worth and asks what today's price already assumes. In the 6-year world, 46% revenue growth every year for a decade. In the 3-year world, there is no growth rate that gets there at all. The model searches all the way to 300% a year and still cannot reach today's price. 3 models in, 2 ladders, and they disagree by $240 a share. Now CoreWeave's answer, because it's a real one. Their older fleets are still fully booked. The contracts are take or pay, so the customer keeps paying whether or not the chip is fashionable. And nobody anywhere has run a GPU fleet this large through a full replacement cycle. So nobody actually knows. Not the company, not the short sellers, not us. That's exactly why we run it both ways instead of picking one and calling it analysis. 2 ladders, now the one customer who decides which of them is real. In the 2025 annual report, named in the filing, Microsoft was 67% of all revenue. 67. In the first quarter of 2025, the largest customer was 72%. By this March it was 45, with a second customer at 20, widely understood to be OpenAI. That slope is the entire multiple. Concentration falling is the bull case happening in real time. Concentration stalling means one contract renewal decides the company. And it's all bought on credit. $35 billion of debt against $2.3 billion of cash. Free cash flow minus $10.6 billion over the last 12 months. CapEx was $6.8 billion in a single quarter, with $31 to $35 billion guided for the year, against $12 to $13 billion of revenue. Interest expense went from $264 million a quarter to $536 million in 1 year. It doubled. Put those 2 facts next to each other and you have the whole bear case in one line. The growth is real and it's rented. Every gigawatt that arrives brings a loan with it, and the loan is due whether or not the customer renews. One more thing worth saying plainly. NVIDIA sells CoreWeave the chips, owns $2 billion of the stock at $87.20 and has been a customer. Supplier, shareholder, buyer, that isn't an accusation. It's a structure, and structures like that make a market nervous. 11.8% of the shares are sold short going into this print, and consensus earnings estimates were cut 18.6% in the last 30 days. Every model so far picks one future and prices it. The next one refuses to. Instead of predicting one future, the machine rolls the dice on 10,000 of them. Some where AI demand keeps exploding, some where it stalls, some where the bubble bursts. Every roll prices the stock. Stack 10,000 answers and you don't get a guess anymore, you get the shape of the future. So here are the dice named. Demand, does the 12 to 13 billion guide hold? Cash margins, the 56 against the 1. The useful life, 6 years or 3, rates and refinancing against 35 billion of borrowings. And concentration, whether Microsoft's share keeps falling. Fixed seed, public inputs, no hand picking. So here is the shape. The median of 10,000 futures lands at $14.11. 90% of them land between $0 and $276, and 27% of those futures finish above where the stock closed on Friday. Look at the width of that shape before you look at the middle of it. The width is the honest part. And here's what would actually move it, not sentiment. These 4, the useful life assumption, the backlog conversion rate, the refinancing cost on that debt, and the Microsoft share of revenue. Every one of them gets updated on Tuesday's call, which means you can score this yourself in about 48 hours. Quick, honest ask, this show is brand new and every one of these models takes days to build. If you want to see the next stock on this table, the subscribe button is how you vote. It genuinely decides whether this series continues. One last board, and the framing matters more than the number. This is not a prediction, it's a stress test. We borrowed the worst crashes in market history and asked one question. If it happened again, where would the math land, applied to the 52-week high of 153.20? The Microsoft path, the Nasdaq path, the Intel path, the Cisco path. 56.68, 33.70, 27.58. 21.45, against a fundamental floor this model puts at 0. The stock is already down 41% from that high. The panic math and the earnings math disagree, and the gap between them is where fortunes moved in 2002.
One sentence would decide this. Here's what it did. In the 6-year world, the models land at $120.47. In the 3-year world, they land at $14.11. Same company, same filings, same set of public numbers, and a gap of 88% between them. Nobody on Wall Street can close that gap for you because closing it means knowing how long a graphics card stays worth renting. And the honest answer is that this experiment has never been run at this scale before. So, the price going in, $90.67. The model's perfect price, $67.29, which puts the chip at overvalued. That's not a recommendation, and it never will be. It's what the arithmetic says when you feed it public numbers and refuse to flatter them. And here's the part I care about. Going into Tuesday, the market has bid this stock up 26% in a week, straight into a number nobody has seen yet. The models say the 6-year world and the 3-year world are still 88% apart, and the middle of that disagreement sits about a quarter below where it trades. When those two disagree, one of them is early and one of them is wrong. Tuesday is a vote, not the answer, and you probably don't find out who was right for about a year. I'd rather show you both than pretend I know. None of this is financial advice. These are deep models built on public numbers. And every model on this board has been wrong before. That's exactly why we run all of them. And the models are timeless. When Tuesday's numbers land, rerun them with the new figures, because that's the only version of this that stays true. There's another AI stock reporting this week. It says it booked $60 billion of orders and its last auditor quit. The models price that one next on the channel.